Hello and welcome. In this video, we will learn what hedging is. Alright? Now, hedging in simple words means protecting your portfolio. Now, you can hedge with futures, you can hedge with options too, or a combination of both. But in this video, we will learn to hedge with the help of options. Alright? Now, let me take an example. Let us say that you have 4,000 stocks of Z Entertainment Limited in your portfolio. Alright? Or let us say that I have 4,000 stocks of ZEAL in my portfolio. Okay? It is either I or you. I keep switching between you and I while explaining. So do not get confused by it. Okay? Sometimes I say I, sometimes I say you, but the aim is same. Okay? So do not get confused by it. Now what is portfolio? The investment, the long-term investment that you have made, the stocks that you have or own. Okay? That is what basically portfolio means, your long-term investment. Now you have 4,000 stocks of Z. Now let us say that today is June 15th. Today is June 15th. And the spot price of ZEAL is 200 rupees. Okay? Today on June 15th, one stock of ZEAL costs 200 rupees. So basically, my portfolio is worth 8 lakh rupees. 4,000 into 200 is 8 lakh rupees. So this is basically my worth, okay, worth of my investment. Alright, now rupees, dollars, yen, it doesn't matter. Okay, now today the date is 15th. There is an announcement by the company about their profit and loss tomorrow. Okay, tomorrow the company is making an announcement about their profit and loss. Now, according to my analysis, I have a feeling that the announcement will be bad. Okay, and so I have a feeling that the price of the stock will go down. This is my feeling. I might be wrong. Alright? The announcement may be good. The stock price may go up. We do not know. What I feel is it will go down. And I can bear a loss till 180 rupees. Meaning current price is 200. If it goes down, it is okay. Okay, till what price? Till 180. So I can bear this much down movement of the price. Okay. So if it goes from 200 to 180, it is fine. Anyhow, stocks move up and down. The price moves up and down. Correct. So if it moves till 180, I can bear it. It is okay. But then if it goes below 180, then I have a problem with it. So to protect my worth, okay, to protect my portfolio, I am going to hedge the stocks. I am going to hedge with options. Okay, so we have options of ZEAL being traded in the exchange. So I am going to use them to cover up some of the losses or to reduce the losses that I will be making due to the down movement of the price. Okay, now how do I do it? Let us see. What I can do is I can buy put option or I can sell call option. Now, spot price is 200 rupees, correct? Today is June 15th. The spot price is 200 rupees. I feel that the price will go down tomorrow after the announcement. When you believe that the price of stock will go down, what do? You buy put option or you sell call option, correct? You can do this or you can do this too. Both are same. When the price is supposed to go down, you can do this or you can do this. Okay? Now, as I said, it is okay if the price goes till 180, but if it moves below 180, then I cannot bear that movement, that much loss. So what I do is I buy the put option or I sell the call option of this strike price. Okay. Now call option premium is 10 rupees, put option premium is 5 rupees. Now these values are made up by me to keep the calculation simple. Okay, these are not actual values, not taken from option chain. Alright. Now you can do this, you can buy put option by paying 15,000 rupees. Why 15,000? 5,000 put option premium into 3,000, which is lot size of zeal. Okay, lot size of zeal is 3,000. One lot has 3,000 stocks. So 5 into 3,000 is 15,000. So you can buy put option for one lot by paying this much, or you can sell call option by receiving this much premium. Call option premium is this much. So 10 into 3,000, 30,000. So you can sell call option by receiving 30,000 premium. Okay, you can buy put option by paying this much. You can sell call option by receiving this much. Okay, and the expiry is June 29th. The expiry is June 29th. Alright? Yes. Now, you see, I have 4,000 stocks in my portfolio, but I am hedging only 3,000. This is because one lot of zeal has 3,000 stocks. There is no option for me to buy options or sell options for 4,000 stocks. I cannot do that. It is either 3,000 or 6,000 or 9,000 or 12,000 and so on. There is no option for in between. Okay. So what I decide to do is hedge 3,000 stocks. Okay. I have 4,000 in my portfolio. I decide to hedge 3,000 stocks using options. Now, you will be doing either this or this, not both. Okay. You can buy put option or you can sell call option. You can do any one or you will do any one, not both. Alright. Now, expiry is June 29th. We will see various conditions that may arise on June 29th. Okay. On the left side are the conditions and their results for put option buyer. Okay. If you had bought put option by paying 15,000 rupees, then what would have your profit and loss been? That is what will be here. And on the right side will be the details of call option seller. Call option seller has received 30,000 rupees by selling one lot of zeal options. So what will be his profit and loss? That will be on the right side. Okay, and this will be on the day of expiry, not in between. Okay, so on 15th spot price is 200 rupees, and that is when you decide to buy put option or sell call option, because you feel that on 16th after the announcement the price is going to go down. Okay, now first condition is that stock price reaches 180 rupees on the day of expiry. Okay, so on 16th announcement is made and it is bad, and so from 200 it goes to 180 rupees, and on the day of expiry it will be this much. Now what happens if the price goes to 180? Loss in portfolio is 60,000 rupees. Now what is portfolio? The stocks that you have as long term investment, that is portfolio. So the loss in portfolio is 60,000 rupees. How is it 60,000? Spot price on 15th was 200 rupees, correct? Spot price was 200 rupees. Now it has come to 180. So 20 rupees it has gone down. So 20 into 3,000 rupees is 60,000 rupees. So it has gone down by 60,000 rupees. Now you see, I had 4,000 stocks in my portfolio, but I have not taken 4,000 here because I am hedging only 3,000. So I am considered only about 3,000 stocks. Okay, only about 3,000 stocks. So loss in portfolio is 60,000 rupees. And along with that, there is a loss in option too. This is in stock, this is in option. I had bought put option by paying 15,000 rupees, correct? So that too will be gone because the price did not go below 180. It came and stopped at 180. So I am going to lose 15,000 too. So totally 60 plus 15,000, 75,000 is my total loss if the price comes to this on the day of expiry. Okay. Next, if we consider here for the same condition, stock price coming to 180, the loss in portfolio is same. Loss in portfolio is same, 20 into 3,000. But then I gain the premium. I gain the money in premium, option premium, 30,000 rupees. Okay, 30. I had sold options, correct? I had sold options of 180 strike price by receiving 30,000 rupees premium. And since it did not go above 180 rupees, I am going to keep this premium, 30,000 rupees. So this is gain, this is loss. Totally the loss is 30,000 rupees. Okay, 30,000 rupees. So even though the price reached 180 rupees, I was able to reduce my loss to 30,000 rupees. If I had not sold option here, if I had not sold the option here, this would have been my loss, 60,000. So by selling call option, I was able to reduce the loss to 30,000 rupees. This is called as hedging, reducing the loss in the portfolio by doing something. Okay, by doing something like this is called as hedging. Whereas if we consider this, there is a loss here. If I had not bought put option, then this would have been my loss, 60,000. But now since I had bought put option, that too goes as loss, and totally it is 75,000 rupees loss. So even though I have hedged it, I have made a wrong decision in selecting the strike price or maybe the time of buying the put option. Okay, so this is wrong selection, and so I have a loss here. Now let us take second condition. The stock price goes to 150 rupees. Stock price goes to 150 rupees. It was 200. After announcement, it went to 150. So the loss in portfolio is 50 into 3,000, which is 1,50,000 rupees. Rupees or dollars if you are from another country or any currency. Alright, it doesn't matter. Now, loss in portfolio is 50 because 200 was the price when I had bought the option or sold the option. Now it is 150. So 50 it has gone down. 50 into 3,000 stocks. I am hedging only 3,000 stocks. So this is the loss that I am worried about. Okay, 150. But then I gain in the option. I had bought 180 strike price put option, correct? Put option by paying 15,000 rupees. So I gain in option. How much do I gain? That is 175 minus 150 into 3,000 rupees, which is 75,000 rupees. So totally 150 minus 75 is my total loss. So 75,000 is my total loss. If I had not bought put option, then this would have been my total loss. But since I had bought put option, I have gained 75,000 in it, or you have gained in it if you had done it. Okay, I keep missing you and I, so sorry for that. It is either you or I. So you gain 75,000 rupees and total loss is 75,000 here. Okay. Now, what is this 175? What is this 150? 175 is the break even amount. Okay. 175 is the break even amount. I or you had bought option of strike price 180, correct? 180. By paying 5 rupees premium per stock, correct? So 175 will be break even price. We have learnt about break even price before too, correct? So I'll not go into detail about this. So 175 minus 150. What is 150? The current price. So 175 minus 150 into 3000 gives you this amount. Okay. So by hedging, I was able to reduce the loss from 1,50,000 to 75,000. Now, in this condition, if you are a call option seller, or if I am a call option seller, the loss in portfolio is same as this. Okay, 50 into 3000. But here I gain in option, and the gain is limited to the premium that I receive from the buyer, which is 30,000. Okay, whatever the price may be, it may be 140, 130, 100, or whatever it may be, this is limited, correct? You know this profit and loss of a seller or a buyer. The profit of seller is limited, and that is limited to the premium that he receives from the buyer. So here I or you gain in the option, that is premium amount, which is 30,000 rupees. So 150 minus 30 is 1,20,000 rupees. So the total loss here is 1,20,000 rupees. Okay. So you can see that if you are a put option buyer here, then you have an advantage. You have an advantage if your analysis is right. Okay. Now, what if your analysis is wrong? What if the price, instead of decreasing, goes up? What if the announcement is good and the price goes up? What if on the day of expiry the price reaches 220 rupees? If the price reaches 220 rupees, I gain 60,000 rupees in the portfolio. It was 200 rupees on 15th June. Now it is 220. It has moved up by 20 rupees. So 20 into 3000 is 60,000 rupees. So this is what I gain in the portfolio. Whereas in the option, I lose 15,000 rupees, which I had paid while buying put option. So this is the maximum I am going to lose. So I lose 15,000 rupees, I gain 60,000 rupees. Okay. So the difference is my gain. 60 minus 15 is my gain here. But here in this case, if the price goes to 220 rupees, the gain in portfolio is same, 60,000 rupees. But then there is a loss in option. You know that loss for a seller is unlimited. Correct? Unlimited. So here it is 220 minus 190. Why 190? Because this is the break even point. So 220 minus 190. I had paid 10 rupees, or I had received premium from seller at the price of 10 rupees per stock. Correct? So 220 minus 190 into 3000. So this much is my loss. This much is my loss if the price goes to 220. Imagine if it goes to 250, 300, 350, 400. What would this loss be? Correct? So this is my loss. This is my gain. So 60 minus 90 is minus 30, or I would still be in loss. Okay, so this is what you can expect if you are a call option seller, or if I am a call option seller. Alright, so this is put option buyer, this is for call option seller. You can see that in this case we have reduced the loss by hedging. In this case we have reduced the loss by hedging. In this case we have reduced the loss by hedging. In this case, the market was not in our favor, or our selection was not right, and so we did not gain much here. Okay, so this is the concept of hedging. By hedging, we are aiming to reduce loss in the portfolio. Alright, I hope it is clear. So that's it for this video. I'll see you in the next video. Till then, take care and thank you for watching.